Understanding loan loss provisions, an essential aspect of banking finance. In the intricate world of banking and finance, a key concept that governs the financial health of lending institutions is the loan loss provision. This mechanism, though technical in nature, plays a vital role in managing risk and ensuring stability within the financial system. In this article, we will delve into what loan loss provisions are, how they function, their significance in accounting, and why they are critical for financial integrity. What is a loan loss provision? A loan loss provision is an expense on a bank's income statement that is set aside to account for anticipated losses on loans that have been issued but may not be repaid. These provisions serve as a safety net for banks by covering various types of potential losses, such as non-performing loans, loans where the borrower is not making interest payments or repaying any principal. Customer bankruptcy, situations in which borrowers can no longer meet their financial obligations due to insolvency. Renegotiated loans, loans that have been modified to reduce the repayment amount, often resulting in lesser recoveries than initially estimated. By making these provisions, banks strive to mitigate the impact of bad debts on their overall financial performance. The mechanics of how loan loss provisions work. The banking sector primarily generates income through interest and fees associated with loans. In various economic conditions, the likelihood of defaults can increase, necessitating a proactive approach to financial management. The landscape of banking has seen significant changes, especially post the 2008 financial crisis. Stricter regulations, such as those outlined in the Dodd-Frank Act, have mandated banks to adopt higher lending standards and maintain better capital reserves. Such measures aim to elevate the quality of borrowers and enhance the liquidity position of banks, ensuring they can cover unforeseen losses. Despite these advancements, the reality remains that late payments and defaults still occur. Therefore, banks regularly set aside loan loss provisions to adjust their loan loss reserves, which ultimately appear on their financial statements. When these provisions are recorded as expenses, they lead to a decrease in the bank's operating profits, influencing the perception of their profitability. Importance of loan loss reserves in accounting. Loan loss reserves fundamentally depict a bank's commitment to prudent financial practices. They are crucial for ensuring transparency and accuracy in the representation of a bank's financial health on their balance sheets. Typically, these reserves can fluctuate over time through two main mechanisms. 1. Increases. When a loan loss provision is made, it adds to the total reserves. 2. Decreases. If a loan is charged off, i.e., deemed a total loss, this amount is subtracted from the reserves. To accurately forecast potential losses, banks employ various methodologies to evaluate and update these loan loss reserves. This may include analyzing average historical default rates, assessing credit loss forecasts for differing borrower risk profiles, and utilizing collection performance metrics of their portfolio. Balancing risk and reward. The relationship between loan loss provisions and a bank's operational viability is a delicate balance. By prudently managing provisions, banks can maintain an equilibrium between risk and reward. Adequate provisions enhance a bank's capability to absorb shocks from loan defaults, ensuring long-term sustainability and fostering confidence among stakeholders. During quarterly financial disclosures, banks present their performance, including the figures related to loan loss provisions and loan loss reserves. This transparency is essential in bolstering investor confidence and ensuring compliance with regulatory standards. Conclusion. Loan loss provisions are a critical financial tool that allows banks to be proactive in managing potential losses from their lending activities. By establishing these allowances, banks can not only comply with regulatory requirements but also present a clearer picture of their financial health to investors and clients. As the financial landscape continues to evolve, the methodology surrounding loan loss provisions will also adapt, reflecting broader economic conditions and lending practices. Understanding loan loss provisions is essential for anyone involved in finance, as they significantly influence a bank's stability and performance in an unpredictable economic environment.